You've been listening to the Senate Banking Committee hearing on banking failures. Of course, you can keep up to what's been happening on T-Live and LiveGo on the Bloomberg terminal. A lot of focus for Federal Reserve Vice Chair for Supervision Michael Barr was when regulators and supervisors became aware of risks at Silicon Valley Bank. There was a discussion around a presentation made by his staff in February. Beyond that, a lot of the focus as well was on the responsibility of executives at Silicon Valley Bank, the actions that they took, as well as an emphasis on the timing of stock sales that Silicon Valley Bank executives took prior to the bank's collapse. The FDIC's chair, Grunberg, also accounting for the costs to the government of around $20 billion as a result of SVB's collapse. And why in that initial weekend there was not a solution or a buyer in the first 48 hours following its collapse. Let's go out to Washington, D.C. and Bloomberg's Anne-Marie Horden, who's going to wrap up the latest. Anne-Marie, at times combative, but really the focus was on accountability.
Accountability and also the next steps. What you're hearing from these top regulators, and they were asked by Senator Elizabeth Warren and the Democrats who want to see more regulation, is that they think that some of this needs to change, especially when it comes to capital requirements and liquidity for banks worth more than $100 billion. Now, this is going to be something that the Republicans are not going to be able to get on board for. They do not think that there needs to be more regulation. They think enough regulation is in place. And as the supervisors who missed it, you heard from Senator Tester saying the supervisors were showing that there were issues, but no one came down with a, quote, hammer in terms of making sure to fend off some of these concerns. You could see the politics in all of this as well, because the Democrats really want to point, as you've seen there, due to what happened in 2018, which is a rollback of some of these Dodd-Frank banking regulations. But remember, Ed, even some moderate Democrats voted for that. But looking ahead, of course, we have another hearing tomorrow on the House side. Again, that likely you'll hear some more of this combative remarks and potentially political remarks with these regulators. But also, everyone is looking forward to Michael Barr's assessment and report that's going to be due in about a month on May 1st.
Yep, and we'll continue to track that here on Bloomberg Television. Bloomberg's Anne-Marie Horden out in D.C. And if you want more recap, T-Live Go on the Bloomberg terminal. You are watching Bloomberg Technology. Let's stick with this discussion and bring in Sarah O. Lamb of the Technology Policy Institute. And Sarah, we remind ourselves in the context of this hearing that what happened at Silicon Valley Bank impacted its core client base, which was startups and venture capitalists. What have your main takeaways been from what you've heard over the last 3 hours?
Right. Well, I've been watching the hearing, and Vice Chair Michael Barr fielded most of the questions from the senators. It sounds like they're doing a review of what happened and what could have been prevented under direction from Chair Jay Powell. Was there a good way for them to see what was coming? Do they need more stringent standards? He said that size is not a good proxy of risk. So when Silicon Valley Bank grew to over $100 billion in assets, should they have seen that rapid growth was part of the equation? So we also heard him say that his group will be looking at whether they should change its rules, which would take a notice of proposed rulemaking. And they're assessing what they could have done differently.
Sarah, you at the Technology Policy Institute, put yourself in the shoes of the founders and VCs that banked at SVB. Do you think that what they heard from the panel satisfied what they went through and the questions that they may have coming out of it?
Well, for startups and for VCs, I'm not sure if they really considered that Silicon Valley Bank was a regional banking organization. They probably just saw a bank that was friendly to venture businesses. And so it probably wasn't on their mind about whether the bank was sound or not, or how they were managing their assets and their securities. So as a depositor, I think it makes sense for businesses to not have to worry about what the bank that they're banking with is doing. Right. That said, things are different now, and so businesses are flocking towards the bigger banks.
Treasury Undersecretary Liang, who has a real focus on sort of domestic finance, was part of the panel. She got very few questions, but what she did talk about was kind of ensuring the deposit base. What's your assessment of the ripple effects this has had among that deposit base? Are we seeing the health of the startup ecosystem still impacted some 2 weeks after the bank's collapse?
Well, you hear a lot more about how businesses are learning about cash management. And so, apparently they were holding millions of dollars in their cash and checking accounts. And now there are other banks that are saying, oh, you can use our sweep accounts, you can use our money market accounts, you can buy treasury bills through our banks. So it is a lesson for businesses on how they're managing their cash. It's unfortunate that they have to learn this way about banks. That they can't just keep cash in a checking account. But hopefully with more oversight, this won't happen again.
As Bloomberg's Anne-Marie Horden reported, one aspect of the focus was accountability. The other is the what happens next. From a policy perspective, what to your mind needs to change coming out of the SVB collapse?
Well, you're going to see a lot of administrative process happening. So Vice Chair Michael Barr said that they would need to do a rulemaking proceeding in order to change their rules. And they are having to implement the 2019 Economic Growth and Consumer Protection Act. And so it will be the realm of regulators discussing and getting public comments on how to tighten up this monitoring regime.
Sarah Olam of the Technology Policy Institute with instant reaction to that Senate Banking Committee hearing. Thank you very much. Now, coming up, a changing of the guard at rideshare Lyft. Our conversation with the incoming CEO, David Risher. That's next. This is Bloomberg. Lyft shares have declined, and those declines accelerated after the new CEO, David Risher, told me the company is not for sales. The share had been up earlier in the session on news of his appointment, but now we're at session lows. Have a listen to the conversation which took place earlier this morning.
First of all, I would characterize it as a crazy idea, but we'll come back to that.
Why is it crazy? Because it's outside of your CV, what you've done in the past.
In a sense, but in another sense, it isn't. You know, I was at Amazon, focused on the customer. I was at Microsoft, focused on competing. I built a nonprofit that gets 20 million kids reading with very limited resources. So
trying to do quite a lot with very little.
That's the idea, yeah. But they approached the board, actually, at the end of last year, saying it was time for them to think about the next thing.
With your name, or just generally speaking, at the end of last year? Okay.
That's right. And then the board created a search committee, as they do. They hired a search firm, as they do. They saw hundreds of people, dozens of strong candidates in the end.
Right.
They came to me and said, maybe you're the guy.
Okay, so when they came to you, what was it that they wanted you to do? What was their kind of big pitch around why Lyft would be better under your leadership?
You know, I think they are really proud of what they've created, and for good reason. I mean, the rideshare sector exists in large part because of Lyft. They're the ones that introduced the whole concept of shared rides. They're the ones that introduced tipping for drivers and so forth. But I think they realized at a certain point it was time to pass the baton to somebody else.
Right.
They looked at my background and said, I think you're the guy.
Do you go into this sort of acknowledging that Lyft is kind of increasingly distant, smaller second player in rideshare now?
Well, I don't love the word increasingly, but I certainly do think it's number two.
Well, you hope to reverse that, probably.
I do. That's the idea.
So what it comes down to, and a lot of the analysts and investors talk about, is diversification.
Yeah.
What is your plan for Lyft at this early stage? Does it remain a rideshare business, or do you JV with other delivery platforms? Do you expand the business offering? Yeah. Where's your head at with that?
Yeah, so I'll tell you where my head is. I guess I reserve the right to change my mind, of course, because
Fine.
But look, I think our focus is rideshare, and I'll tell you why. The United States is going through a crisis where we've all been locked inside our houses, where we've all been locked outside of work, and now we're coming back. And I think if you look at happy, well-lived lives, bringing people together is a really, really good idea. And I'll tell you what, if you try to also deliver pizzas and packages at the same time, it might be a good business model, we'll see. But I don't know that it's a great experience for passengers.
But you're not ruling it out. I have to ask.
Which?
Expanding beyond just pure play rideshare.
Not ruling it out, but really the focus is going to be on picking you up on time, matching price, making sure you get dropped off on time. That's the focus.
I think what's so interesting about Lyft is people use Lyft. Strange thing to say, but I went to our audience and I said, look, the new CEO of Lyft's coming on the show. What should I ask him? And actually, the majority of people say, when is Lyft going to get outside of North America? There are people in Europe that want to know when Lyft's coming. Maybe the idea is that competition brings better pricing, but have you thought about that in international expansion?
I mean, look, I love your second point. I do think that's right. I think competition is good for everybody. And that's a generic statement, but in this case specifically, I think you're better off if you've got one service and maybe they disappoint you a little time, you go to the other. We keep each other honest. Whether or not we'll go to Europe, that's for the future.
There is a big question in the marketplace right now. Is Lyft for sale?
No.
Not for sale?
No.
Do you see why people might think you coming in opens the door to that, being acquired by a larger player that does something different, or does it not make sense to you?
I mean, look, people can make these sorts of arguments about how aggregation is good, but my argument right now is on focus, on really making sure that for our customers and for our drivers, we're doing a great job.
You talk about when you were at Amazon learning to obsess over customers, and I've been trying to work out how you obsess over people that take ride sharing, but I guess it comes down to pricing.
I think it starts, well, no, let me say it a different way. I think if you're not price competitive, you're not in the game. So let's just call it that. If you're not price competitive, you're not in the game.
Is Lyft price competitive?
That's our goal, for sure. Whether we're there or not, that's to be determined, but for sure that's our goal. But I think then you build on top of that. And I really do think you can build over time differentiated products and services. I won't go there today, but I think that's where you'll see us go.
The phrasing that people use is pricing war. And we're trying to monitor real-time pricing, right? Lyft versus Uber in Manhattan or in New York City or here in the Bay Area. Are we already in a pricing war?
Well, you tell me. What have you found?
Well, there are anecdotal evidence, where one ride in Manhattan may be $10 cheaper on Lyft one moment, but more expensive the next. What is your goal in that respect is the bigger question.
Our goal is to match. Our goal is to match. And look, if you get in a Lyft and you have a problem with the Lyft, that the price is too high, or you don't get in because the price is too high, my email address is david@lyft.com. Send me a note. We want to know.
That was my conversation with Lyft's new CEO, David Risher. Now, let's turn to Microsoft, announcing its latest innovations in artificial intelligence. Microsoft's Security Copilot. The new program uses over 65 trillion security signals per day to help keep its potential clients safe. Joining us now is Microsoft Security CVP Vasu Jakal. Vasu, thank you for joining us on the program. Let's start with the rationale. Microsoft's done a lot with AI in a matter of weeks. Why was the security tool important?
First of all, thank you so much for having me here. It's great, and we are really excited about our announcement this morning. To understand why we launched Security Copilot, we have to go back to the threat landscape. It's been an incredibly challenging few years for security. We're seeing attacks, password attacks, increase to 1287 from just 567 2 years back. It takes less than 2 hours now from when a user clicks on a phishing link for an attacker to get full access to their private data, their inbox. And we're facing a global talent shortage of 3.4 million jobs. So the odds are not in the favor of defenders today. It's an asymmetric war. And what Security Copilot enables us, it empowers defenders to defend at the speed and scale of AI.
Vasu, Microsoft's been working in cyber and security software for some time. Does the relationship with OpenAI and Security Copilot actually mark a technological advancement, or is this just a marketing exercise for your security offerings?
It does absolutely mark a technology advancement, and it really brings two worlds together and creates this network effect. What Security Copilot does is it builds on the OpenAI large language model, the GPT-4 innovations from OpenAI, which are groundbreaking. And then it builds on top of it with a cyber-specific model from Microsoft, which is informed by Microsoft's global threat intelligence, 65 trillion signals, and very unique cyber skills like threat hunting, finding threats, investigation, reverse engineering. So it brings these two technologies together in a way that has never been done before. And it is absolutely the first and only model in a generative AI technology of its kind.
Vasu, in late January, a headline crossed the Bloomberg terminal that Microsoft had passed $20 billion in sales for its security platforms and offerings over the past year. How does this new AI-powered tool boost sales? Can you put a number on it?
Today, Microsoft protects 860,000 customers across the world, and we are incredibly proud of that. Customers are choosing Microsoft in their journeys, and what Security Copilot does is it builds on it. It works with our end-to-end security tooling, which, by the way, we absolutely believe is necessary. You have to lock all doors and all windows to have a safe house, and that's our approach. And it builds on this because it simplifies security for all defenders everywhere. It catches what others miss because it's able to give you this entire signal graph, the attack kill chain, and it helps you address the talent shortage by augmenting your teams with skills that they may not have. So we look upon it as a best of all worlds to take us to the next era of security.
Thanks to Vasu Jakau and Microsoft. We're going to catch up later in the year at RSA. We'll track your progress. Thank you. Now, as we head to break, let's check in on shares of Alibaba. These are the US-listed ADRs. The company announcing overnight it's going to split its 6 business units. We're going to have those details next. But you look at shares really flying up 12% on a 2-day basis. This is Bloomberg. Continuing to watch shares of Alibaba up 13%, biggest jump since June of last year after announcing a split to its business into 6 units. Bloomberg's Isabel Lee joining me from New York. Isabel, what are the details of a new look Alibaba?
Hi, Ed. Investors are definitely liking what they're seeing. So Alibaba's sprawling $220 billion empire will be split into 6. So this includes a unit on cloud intelligence, on digital business. And why do investors like this? Because a lot of people are saying that when Beijing cracked down on too big to fail tech companies, Alibaba was one of those in the spotlight. And this will make them under less scrutiny. Right. But the thing is, it's also hard to imagine that this move was done without Beijing's consent. So this was likely something that they planned with the government. Of course, we don't know the details. We don't know what actually happens behind closed doors. And it's also interesting that this happened just a few days after Jack Ma reappeared. Actually, it was just Monday that Jack Ma reappeared, and that sent some shares of Chinese-listed stocks soaring.
The other interesting thing as well is 6 new business units means 6 potential new IPOs, right?
Yes, and that's going to revive a lot of that. I mean, I don't want to assume that they will do their debut in Hong Kong, but then we know that IPOs all over the world have really been lackluster. Like my friends in the capital markets group, they don't do anything. So they're saying that this may revive that. And also, it's up to them on how they plan to list, how to raise money, and IPOs is one of those.
All right, Bloomberg's Isabel Lee, thank you so much. That does it for this edition of Bloomberg Technology. So much more to come this week across the technology sector. This is Bloomberg.